Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Tuesday, February 21st, 2023. It's now the 18th. We start off in the S&P 500 daily chart in DeMark looking back to end of October 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential buy setup 2 count. And to negate that for end of day Tuesday, there must be a close above 4136.13 for the price flip to the sell setup count 1. Relative retracement disqualified up 1 can become qualified with a close above the close on the 17th for end of day Tuesday. Keep going and close above the buy TDST lines, and those will become qualified too. Price has been under the conversion line and above the baseline for 2 days. There should be okay support down here by the baseline, and right under there the channel 3 low. Failing in that, the relative retracement disqualified up 1 can be considered support. I have turned lines on and a couple of other things off so that we can see the lines, and all of these ongoing supply lines could become qualified with closes above them. Same thing to the downside. This ongoing demand line and this one too. This ongoing demand line was qualified and confirmed. It had a close below it and then opened below the close the next day, ticked lower, closed lower than the close. So that's qualified and confirmed. So now the short-term goal to the upside would be to get to and above this former demand line 4097.82 and start moving up past that. If not, and continue heading south, get this ongoing demand line qualified and then maybe possibly confirmed. This one also, then there's big trouble. I turned the 50% propulsion back on to see that that could be support also there, 3987.01. It's nearby the relative retracement disqualified up 1 and before this ongoing demand line. The NYA top color chart shows the NYA to SPX ratio, basically value over growth, showing growth having a bit of problem getting up to this horizontal line from the ascending triangle here. Needs to get past that, past the other line here from the triangle, and then start getting above these two again. And that would take a lot of big fat cap megatech weakness to allow value to blast through those levels. And for this past week, you can see the ratio going sideways in a very small range here. And that means nothing is doing well. You could see that down here in price. The NYAD line has started rolling back over. It's going sideways too, pretty far away from its 50 EMA in green, which is just slightly above the top line of the descending broadening wedge that it has broken out of. And right under there in red now is the simple moving average 200 here. And the ratio adjusted McClellan breadth oscillator is forming a complex pattern under 0, just like it did up here above 0. Now it's got one going on down here. And NYA price has managed to stay above this horizontal green line that connects these big W peaks here. So it's in between that and then the support and resistance green line up here going back a ways. And the ratio adjusted McClellan volume oscillator is forming a complex pattern under zero like the breath oscillator. And the ratio adjusted summation index of the ratio adjusted McClellan breath oscillator here is at 849.32. It's come off of its high peak up here around 1100. And it's barely above its EMA 21 signal line at 848.21 here, that red line. And the index is at 849.32. And you can see that when the summation index goes under that 21 EMA, it's not a good indication of anything good going on. However, we give it the benefit of the doubt until it gets down to 500. See if it can get near there, down towards it, and bounce back up. You could see back here in the free money era, beginning of 2021, it just had a little trouble getting above it again after it fell under it, but eventually did, and had a little bit of a roller coaster ride for quite a while. And if this over here starts looking like this over here, then that means the training wheels have been kicked off the bike and we're upright and headed straight ahead. As this is quantitative easing big time over here, stimulus, etc., and over here is the antithesis of that, or complete opposite. And think about it, we would have to look back beyond the 50s and before that to see if anything looked like this back then. Maybe I'll do that as a project one day. And that's when the stock market used to stand on its own before all the Fed intervention, stimulus, etc. Same thing goes for the ratio adjusted summation index of the ratio adjusted McClellan volume oscillator here. So the volume summation index, same thing as over here. If it starts looking like that or follows this along down, our SI 14 is right under the 50 equilibrium line, 49.85, and on balance volume took quite the leg down, went underneath its signal line, and starting to test some of these downtrend lines here in dashed red. And the New York stocks only AD line is still above its 21 EMA signal line, but pointed down and fast approaching some of these downtrend lines here, this one. And the McClellan breath oscillator down here of the stocks only AD line up here is headed down and still in this bearish divergence, so it doesn't look like we're going to be getting out of that for quite some time. The NYA intermediate term volume oscillator has rolled over, went below its 10 simple moving average signal line, below this support and resistance line in dashed red, and headed down, still in a minor higher high and higher low until it gets underneath here. About the same thing with the NYA intermediate term breath oscillators in a major higher high here, as you can see. It went below its signal line, horizontal line, headed down. Won't be a major lower low until we get underneath here, that October low. And the instruments above their 200-day simple moving average in the NYA has been bouncing around in the 60 to 70 range here, so that's good to see. I was hoping for some sideways action in here, back here, but it poked its nose above there. The NYA weekly chart, looking back 30 years or so with all the rising wedges. And we'll zoom into this area now. And you could see the free money era in dashed blue here. in the form of an ascending broadening wedge pattern. Look at that, just catching all that manna from heaven. And then the music stopped, 2022. So now it's in a descending wedge pattern that it broke out of in January, beginning of January. You can see it. I made a range here in the dashed blue horizontal lines. So went up and got above that, and then hooked around and came back into this range here. And I'm zoomed in as far as I can to the New York AD line for this weekly chart. And you can see it's about the same as price above, where it broke out of its descending broadening wedge pattern here, and then hooked around and wants to try to get back under there, it looks like. And now onto the stocks only AD line for the weekly chart. And it's about the same here too. It busted out above its descending broadening wedge top line here and wants to try to get back underneath it. And here's a view zoomed out. You can see the New York AD line fell out of its rising wedge here and formed this descending broadening wedge. And the stocks only AD line ascending broadening wedge here formed a descending broadening wedge within it. So this will be the critical area down here as this ascending broadening wedge lower line here intersects with the descending broadening wedge pattern here's lower line. So price gets into this area, I would call that critical to see if it goes under. The New York high-low made it under its 10 EMA, meaning the blue 5 crossed under the 10, and the Rock 12 was at 0.28 when that happened, so that's about as perfect as it can get. You can see the short-term KST went under 0, and the intermediate term and long-term KSTs are countering each other, meaning the intermediate term is pointed down, long-term pointed up, so I don't expect much of a down move, but this is about as good an indication as one can get to confirm that we will see more downside. And the NASDAQ 100 high-low has a chance. The 5 is pointed down towards the 10, which is going sideways, and the rock is at positive 20, so there's still a little bit of room to get plus or minus 5 down here on the rock, meaning positive 5 or negative 5, at the same time when the 5 EMA in blue crosses under the 10 in red. And if and when that happens, that's the shorting signal for the big fat cap megatechs. And we already looked at the NASDAQ composite itself, high-low chart. The blue went under the red some time ago, and that happened at -6 or so for the rock, so that was nothing to take action on. The NDXT, big fat cap megatech equal weighted index, shows that we have broken out of this diamond pattern right here and ran up to the retracement 0.382 in DeMark, and we know that this is the same target area in Bulkowski's book, that 50% gets hit about 88% of the time, and if it makes it up there, it has a good chance at having a throwback to the breakout area here. And the NDXT has formed an big M pattern here. You can see it in blue. And I can't begin to tell you how many big M's and big W's I've been seeing in the 1 minute charts for the S&P 500. We'll go over that sometime during the week if there's time. So now I've zoomed in. You can see this 5.1% measurement here. That's from the breakout and 5% up. And that's a spot where if it fails there, it's going to go back down, and it didn't do that. It kept going and hit that 50% target up here and then formed that big M. So the measurement rule from B to C here of the big M is 6.5%, and then moved down here brings it almost exactly to the breakout spot right here. So knowing what we know and what we just looked at, that it's probably safe to say that the big fat cap megatechs are going to fall and maybe hit this breakout area in the NDXT, something worth watching. And if that actually happens where it has a throwback, then the chances for an upside breakout past the 50% target here and moving up, which you can see if I zoom out a little, has that NDXT downtrend line above it, then this higher peak over here in purple, and here's the 100% target from Bulkowski's book, and what he's saying, it's going to be lower percentage chance of making it up into this area, way lower than if it turned around here and broke above this 50% without having a throwback. The S&P 500 daily downtrend line chart looking back to March 2021. I'll zoom into the current area now. S&P price managed to stay above the daily horizontal support from 04/07/2021 right here after just about nailing this downtrend line here from 06/03/2021 at 42.92, and then it formed a hammer candle here after a gap down. And you can see in the thumbnail over here the gap down and then the hammer formation. It doesn't have to be perfect right to the top of the wick, pretty close, and that's pretty close. And again, out of Bulkowski's book, that's an above average indication of a bullish reversal. So let's see what happens with that. It has to fill this gap now that it created and start moving up above it. So it has a chance, but there's a lot of forces working against the markets, and staying above that horizontal support line and just about nailing that downtrend line and heading up, that's a really good sign. The US dollar daily candlestick chart shows that it had 3 closes above the 103.42 horizontal line in dotted red here. You can see them up here. Wedged in between that red and white one here is a doji candle just about. And Martin Pring's diffusion indicator for the dollar has crossed above its signal line and headed up, but has been right around this area for 2 days or so. It hasn't moved up very much since it's broken out. Short-term KST went under its signal line, headed down towards 0. Intermediate term KST crossed above 0 and headed straight up. And it looks like the KST for the long term wants to hook up here. So let's monitor that to see if it actually makes it above its signal line soon. And soon, meaning a few weeks or a month or so. Here's the daily gold ETF GLD chart. I'll zoom into this current area here now. And a pile of gold fell right into our lap a couple of times right here. So I made the second buy at this first up day lower close candle right here. And then the next day it actually went under the 38.2 Fibonacci retracement and picked up a little more. And then it just shot straight up. So these two up day lower close candlesticks are bullish, and you can see their opposites over here in black, the down day with a higher close. So we'll look at these red ones here as they actually perform better than these black ones lately. I actually went back pretty far to see which one performed better, and it was actually the up day lower close hollow red ones over here that performed better than the down day higher close black ones like this over here. So they're actually both rare candlesticks, but they certainly happened a lot over here, these down day higher close ones. But on this up day lower close begins with an opening gap down in price from the previous day's closing price, but closes up for the day. This price action can be considered bullish during a downward price move, since initial strong selling in the day becomes exhausted and buyers push the price higher at the close. So that happened for 2 days. There must have been a whole lot of others out there looking at the same thing I am. So now we're in a pretty good position with gold, as if it starts moving below this 38.2 point Fibonacci retracement here in a sustained manner and heads towards this 126 EMA in black, I might not wait around too long and just jettison all gold, especially because of what I'm seeing in the daily gold chart, GLD and DeMark, where the qualified momentum down was qualified and confirmed on this bar right here for the 16th, which also qualified and confirmed the 50% propulsion exhaustion down and the 100% qualified and confirmed propulsion exhaustion down at 157.36. So there was a down close here, followed by an up close on the 14th, followed by a down close below the level in question, the momentum down for 50 and 100%. And then the next day opened lower on the 16th, and the close on the 15th, and then ticked lower on the 16th, lower than the low on the 15th, and then closed below the close of the 15th. And all of that by pennies on a lot of those parameters there. And then on Friday, price tagged the 50% qualified and confirmed exhaustion down at 169.55. There was a low of 169.52. So now that that has been tagged, there's a good chance of it continuing down, and that would mean possibly getting below this ongoing demand line and then possibly hitting the sell TDSTs, and getting below the ongoing demand line would qualify that level, 169.29. However, as long as this 126 EMA line in black is still above the 315 EMA in brown and looking like it's got a nice upward trajectory, we kind of lost it a little bit here, but nonetheless pointed up. So if it can continue doing that, then that will be the stop. If it can get closer to this 38.2 Fibo line here, and gold can stay above in this area up here, and yeah, then maybe you can use this as a stop. But for me, that's too far away right now, and not pointed up like I would like it, this black one, but nonetheless pointed up. So it's a tough call to sit through all that red or let it go. And that was a pretty nice move on Friday. I thought it would become a engulfing bullish candle here, and it tried. It just couldn't make it above this candle wick here on the previous candle, which was a high of 171.60. We had a high over here of 171.47, but it would have needed to close higher than 171.60 to get that, and that would have really been the topper on the cake for gold there. And even worse, it did not close above that first uptrend line in red here. That was about 171.40. So for Tuesday to get above it's about the same, or 171.46 would get that above the uptrend line here. And here's gold daily chart showing the DMI and the QQE. And the DMI ATX has not formed any kind of trend yet. It looks like it wants to hook around. Hopefully it will be an uptrend when that shows that it's trending upwards. However, the negative DMI is above the ATX and the positive is below the ATX. So that green one here needs to get back above the red one, just like the blue fast QQE needs to get back above the slow QQE. And it's in a good position to do that. Below 50 is when you want that to happen, and that'll have a better chance of moving up. And we are paying attention to the D wave down wave, which has printed the D wave down wave B right here, meaning the D wave is on D wave down wave C to the upside here. If it can print that down wave C up here somewhere, and the QQE and fast and slow go back above 50, then we'll start focusing on the D wave up wave, which is on the D wave up wave 3 right now. However, as I mentioned in the previous video, to print that D wave up wave 3, there needs to be a tick higher in price, higher than this high on August 6th, 2020. The S&P 500 support and resistance levels big board chart shows the gray areas at trend factor down 1, 21 EMA, daily horizontal support from 0407 2021, and the pivot point. And price in the aftermarket hours, end of day Friday for the S&P 500 was 40.78. So to the downside is the weekly 65 EMA S2 downtrend line from 0603 2021, which it just about nailed on Friday. S1, the daily ongoing demand line, and the daily baseline. And to the upside is the top gap zone 2 that was just created from that hammer candle, and the daily conversion line disqualified by TDST, the weekly diamond bottom uptrend extension, and R2. And barring any miracle to the upside, the S&P 500 daily chart will print the D wave down 1 and D wave up A. And there's a high probability of the S&P 500 daily chart printing the D wave down 1 and D wave up A, which is at 4142.44. So it would have to open above that level for Tuesday and continue moving up to have any chance from keeping away from printing that. And when the A1 and when those 1As print, or A1s if we're going the other way, they can continue moving to the downside indefinitely. So you could see it could pass all these other prior waves here and just keep going to the downside. Or it gets far as it can to the downside, turns around and heads up, and then the 2B wave, so that's down wave 2 and up wave B, has a chance of getting higher than this high over here. Then the 5 will shift over to where that 2B is and negate the A1, and we go merrily marching onwards and upwards. And again, I can't begin to even tell you how many times I saw that between 2019 and 2022 January, at least 20 times that I know of, and I probably missed another 10 or 15 where the C5 kept shifting like that. The B2 would hit it, C5 shifts, keeps going up, get the A1, B2, rinse and repeat. However, that was through the free money era. If it does it on its own now, then we know we're standing on our own without the punch bowl being out. Somehow the S&P 500 daily AD line closed above its 21 EMA signal line, as did the NASDAQ 100 AD line closed above its AD line 21 EMA. They're both about 1 or 2 points, so that's on the precipice there. And the New York traditional McClellan breath oscillator to get back to zero would require 2,683 advancers over decliners to get back to zero. Have a great day.